Welcome to our CFP exam prep discussion focusing on bond yield measures. Today we're diving deep into three critical yield measurements that often appear on the exam and frequently confuse candidates. Let's start with coupon rate, which is the most straightforward of the three measures. The coupon rate is simply the annual coupon payment divided by the face value of the bond. For example, if you have a $1,000 bond paying $50 annually, the coupon rate is 5%. Many candidates make the mistake of thinking the coupon rate changes with market prices, but remember, it remains fixed throughout the bond's life, unless it's a floating rate bond. Moving on to current yield, which gives us a more practical measure of return. Current yield is calculated by dividing the annual coupon payment by the bond's current market price. Let's say that same $1,000 face value bond with a $50 annual payment is trading at $900. The current yield would be $50 divided by 900, giving us approximately 5.56%. This is higher than the coupon rate because the bond is trading at a discount. The most comprehensive measure is yield to maturity, or YTM. This is where many test takers stumble because it considers three key components: the coupon payments, the time value of money, and any capital gain or loss at maturity. YTM assumes you reinvest all coupon payments at the same yield and hold the bond until maturity. Using our previous example, if the $1,000 bond trading at $900 has 5 years until maturity, the YTM would be higher than both the coupon rate and current yield because it factors in the $100 capital gain at maturity. A common exam trap involves questions about these yields when bonds trade at premium, par, or discount. Here's the relationship you need to remember. For a discount bond, YTM is greater than current yield, which is greater than coupon rate. For a premium bond, it's the opposite. Coupon rate is greater than current yield, which is greater than YTM. When a bond trades at par, all three yields are equal. Another frequently tested concept is how these yields change with market price movements. Many candidates forget that yield and price have an inverse relationship. When bond prices rise, yields fall, and vice versa. The exam might present a scenario where interest rates are increasing and ask about the impact on these yields. Remember, all three yields would increase if the bond's market price falls due to rising rates. Here's a practical tip for the exam. When you see a question about yields, first identify whether the bond is trading at premium, discount, or par. This will immediately tell you the relationship between the three yields and help eliminate wrong answers. Also, watch out for questions that mix up current yield and YTM. Current yield only considers the current price and coupon payments, while YTM includes the capital gain or loss at maturity. One final point that often appears on the exam is the concept of reinvestment risk. While YTM assumes coupon payments are reinvested at the same rate, in reality, this rarely happens. The exam might test your understanding of how changing interest rates affect actual returns compared to the promised YTM. Remember, if rates fall, actual returns will be lower than the calculated YTM because coupon payments will be reinvested at lower rates. Understanding these yield measures and their relationships is crucial for success on the CFP exam. Take time to practice calculations and, more importantly, understand the concepts behind each measure.